Show, we're going to be talking to the management of Persistent Systems on the back of the strong quarterly earnings. Let me now welcome Vinit Teredesai. He's the Chief Financial Officer at Persistent Systems. Vinit, very good afternoon to you, and thanks so much for joining in. A stellar quarter, to say the least. What are you currently seeing on the ground in terms of the growth? Because you are coming off a very strong base as well. What led to this strong outperformance in Q2 FY26?
This quarter we reported a $406.2 million revenue, which is a 4.2% growth on a reported terms and 4.4% on a constant currency terms on a quarter. The same from a dollar terms translates into 17.6% year on year and 23.6% in rupee terms. Our operating margin came in at 16.3%, which is a 43.7% increase year on year. And our PAT margin came at 13.2%, which is a 45.1% increase year on year. So now this growth, if you look at it, it was a pretty much broad-based growth across all the three verticals, led by banking financial services vertical, which grew 6.9% sequentially and 30% year on year. Then came healthcare life sciences, which was in a consolidation phase for last two quarters. It showed a growth of 4.1% sequentially and a 6.6% year on year. And then high-tech vertical, which grew 2% sequentially and 15.5% year on year. So it was a pretty broad-based growth across all the verticals, led by a very strong order wins, both from ACV as well as TCV perspective, and also driven by a lot of our AI offerings being very well accepted and appreciated by the market.
Vinit, you did mention about healthcare as a key sector, and I just want to just take a little bit more perspective from you on this one, because healthcare specifically in the United States has seen some uncertainty over the last couple of quarters. Dodge, amongst other factors, you saw funding to a lot of startups in that space also get impacted. Talk to us about what are you seeing in terms of outlook of the healthcare sector for this year? Do you see that the sub-segments like the research-led companies might take some time to come back, but the other ones in your healthcare division will outshine and grow faster?
So our healthcare life sciences vertical is broken down into 4 or 5 parts. It constitutes scientific instruments, medical devices companies. It constitutes payer and provider companies. It includes pharmaceutical companies, and it also includes clinical research and diagnostic services companies. In addition to that, there are a lot of health startups, health techs, with whom also we work. So at this point of time, if you look at healthcare, has been in the last 2 years a very, very rock star sort of a performance for the last 2 years. At the beginning of the year, because of the Doge and other things, there was a little bit of a consolidation phase. But we had said this in the past also, that first this sector has grown quite rapidly in the last 2 quarters. So there will be a consolidation phase that it will go through, and then the growth will start returning back. And that's what is playing out. At this point of time, we don't believe that there is something that is something that we are worrying about. Obviously, the environment keeps on changing on a daily or a quarterly basis. So forward looking, I can't make that. But at least based on whatever order work and wins that we have seen so far, we believe that this sector will continue and come back to its growth trajectory and continue to grow on a regular basis as it has done in this particular quarter.
Vinit, the margin profile is the other one. It's been very strong for this quarter. Do you see that, in quarter 3, you will see that wage hike impact coming in? How would you describe the margin profile for the company over the next couple of quarters?
So, if you look at our first quarter, we delivered a 15.5% EBIT margin. This quarter, we delivered a 16.3% EBIT margin. We have said that we have rolled out effective October 1 increments to all our employees. The impact of that is going to be around 180 basis points that you will see in Q3. But we have a couple of levers, like we believe our utilization can improve a little bit. We have our ESOP costs that will go down a little bit. We continue to increase our offshoring and nearshoring on some of our customers in both banking and healthcare life sciences vertical, as a result of which is a margin lever for us, without compromising on the business, without compromising or losing any of the wallet share with these customers. And last but not the least, we also have been investing quite heavily in the soft SG&A part for the last 2 years. While we'll continue to make those dollar investments, the pace of investment may not be at the same level. And that is something these are the levers that are available with us. We believe at this point of time, out of that 180 basis point impact that will have on the margins, around 80 to 100 basis point of impact can be actually offset. On terms of the trajectory, we had said 2 years back that our margins will improve as we reach FY27 2 billion target. We want to improve our operating margins by 200 to 300 basis point. At that point of time, our margins were in the 14 to 14.5%. Last year, we delivered for the full financial year 25, we delivered 14.5% operating margin. This year, if you look at our trajectory, we are already at 15.9. So we believe that 100 basis point improvement is already on the way. Despite of some of the headwinds which I talked about in Q3, we should still be able to recoup a lot of most of that wage increment impact, and our margin trajectory will be still in the range of 100 basis point higher than the last year. And as we exit the year, we would like to come back to where we have reported our margins this quarter, and then look at forward. So the 100 to 200 basis point improvement in the margin trajectory is very much on track. At this point of time, looking at our growth, order book, and the pipeline that we have in hand, we believe our 2 billion journey is also possible. We have grown in the last couple of years by 25% on a CAGR basis. This is our 22nd consecutive quarter sequentially where we have grown, and we are confident with all the pitches and the playbook we have, we should be able to reach the 2 billion target without any hassles.
Vinny, that was precisely my next question as well. Your outlook largely on a $2 billion revenue target for FY27. What segments are you targeting? What are you currently seeing on the ground? Because you did about 1.4 to 1.5 billion in terms of revenue last year. Which segments do you expect that to fire in this year?
See, if you look at from a last 12 months, trailing 12 months basis perspective, our revenue is around in the 1.56 billion range. If you look at from a run rate perspective, we are in the 1.6 to 4, 1.6 to $4 billion range. So, we are pretty much on track. We are growing now last 2 quarters and this quarter put together in dollar terms. We have grown almost 18%. And to achieve the 2 billion target, we need to just maintain this momentum. At this point of time, as I said, looking at the order books that we have, plus the pipeline that we are looking at, we believe this 2 billion journey and the growth momentum that we have should continue, and we should be able to achieve that 2 billion target by FY27. Obviously, the only thing which I say, we don't want to become overconfident. Okay, there we understand there is a dynamic environment, but in the last 6 years, when the environment was good, also we delivered better growth. We not only delivered growth, we also delivered better growth than the peers. In the last 2 years, when the industry is struggling, we are still growing, and we are growing handfully better than our competition. So there is definitely a big amount of, we are not a generic IT, so we are a very, very niche product and platform services company. We have a deep product knowledge. We work with our customers very, very closely. Our AI offerings are very, very in an advanced stage, are getting accepted by the customer, the benefit of which is reflected both in our revenue, reported revenue, as well as into the order book. So all these factors put together gives us a confidence that we are playing and making the right investments. Obviously, we'll keep on making course corrections on the way, but we are pretty confident looking at whatever we have and whatever strategy we have put in place, this 2 billion journey should be possible.
Last question, Vinny, to you. Q3 last year, we saw roughly about 4.3% growth on a constant currency basis, of course. Are you expecting a similar profile of growth this year? Do you expect that clients who have been away for the last couple of quarters, maybe the last 3 quarters, should come back in H2 of FY26?
See, I don't think so. There is any material change in the environment that we are seeing as the beginning of the calendar year to right now as we enter Q3. We don't see any material change that has happened. The times are uncertain, the dynamics are uncertain, that every day is a new day. But despite of all of these factors put together, we continue to work very closely with our clients. We continue to win deals against our competition, and we are continuing to not only report a very healthy order book, but also growth in revenue. So at this point of time, as I said, we will navigate. All these challenges have been there for quite a while. They are not unique to Persistent. They are applicable to the entire industry. And despite of that, we are able to deliver this growth. So I think so. That's what you should look at it. Is the company order book looking healthy? Absolutely yes. Is the pipeline healthy? Absolutely yes. Is my growth broad based? Absolutely yes. Is my AI offerings in an advanced stage? Absolutely. So everything all put together, we are pretty confident. So I'm not saying I don't want to become overconfident, but looking at what are the data points what we have, we are pretty confident on our growth trajectory.